Ladies and gentlemen, good day and welcome to the CCL Products India Limited Q3 FY24 Earnings Conference Call hosted by Nirmal Bang Equities Private Limited. As a reminder, all participants' lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Abhishek Navalgund from Nirmal Bang Equities. Thank you and over to you, sir.
Thank you, Manuja. Hello everyone. On behalf of Nirmal Bang Institutional Equities, I welcome all the participants to CCL Products India Limited Q3 FY24 Earnings Conference Call. The management is represented by Mr. Challa Srishan, Managing Director, Mr. Praveen Jaipuria, CEO, Mr. B. Mohan Krishna, Executive Director, Mr. V. Lakshmi Narayana, CFO, Ms. Sridevi Dasari, Company Secretary, and Mr. P.S. Rao, Consultant Company Secretary. Without further ado, I would like to hand over the call to Praveen sir for his opening comments and then we'll open the floor for question and answers. Thank you and over to you, sir.
Thank you, Abhishek. Good morning, everyone, and wish you all a very happy 2024. As far as the performance of the group is concerned, the group has achieved a turnover of rupees 664.48 crores for the third quarter of 23-24 as compared to rupees 535.3 crores for the corresponding quarter in the previous year. And the net profit stands at rupees 63.29 crores as against 73.06 crores for the corresponding quarter of the previous year. The EBITDA is rupees 112 crores and the profit before tax is rupees 66.69 crores. As far as the 9 months YTD performance is concerned, the year-to-date turnover has been 1926.98 crores as compared to 1551.13 crores last year. And the EBITDA for the 9-month period in this year stands at 329.38 crores as against 287.64 crores for 22-23. The PBT for the 9 months period stands at rupees 205.82 crores as compared to 110 crores last year, and the net profit for the 9-month period stands at 184 crores, which is as compared to last year is 183.59 crores. There are 2 updates which I would like to give it to you. In this quarter, during the last 10 days of the month in December, we faced issues pertaining to Red Sea, which meant that a lot of containers which were ready to be shipped could not be shipped because the liners were not taking containers because of the Red Sea issue. That led to deferment of sales from December to January. The quantity was almost 800 metric tons, which is reflecting in the balance sheet, and since most of you wouldn't have it, that is probably you wouldn't have noticed it. But that's one issue that we faced which impacted performance in the last month. And also there is an update on the insurance that we have claimed for the breakdown in the Vietnam unit, and we have filed the insurance with the insurance company. And as we had informed earlier, it's almost 5% of the bottom line. And as far as the claim is concerned, if we get the claim this year, then it gets reflected. Otherwise, we will wait for the claim to come and then we will accordingly inform all of you. So that is the update from our side, and I open the floor for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Kashyap Zaveri from MK Investment Manager. Please go ahead.
Yeah, thank you so much, sir. I hope I'm audible.
Yes, sir.
Yeah. So a couple of questions from my side. One, you mentioned roughly about 800 tons of material which could not be shipped. That roughly probably translates to about 40 odd crores of turnover?
Yeah. Around 48 crores.
Adjusted for gross margin, the full amount would have impacted our EBITDA number also.
Absolutely.
Right. Second is on, in the last quarter when this, breakdown of equipment had happened, what we had highlighted is that, some pushover of volume from quarter 2 to quarter 3. Now, even if I adjust for this about 800 tons, that pushover of that volume ideally should have helped us, achieve a fairly strong volume growth in this quarter, which is probably not visible. So, what explains that?
Okay. So there was no pushover from quarter 2 to quarter 3. If you remember what we had explained in the last quarter, because of the breakdown in Vietnam, we had said that we would try and be a little more aggressive in this quarter to make up for the volume as much as possible. But so it wasn't so. If you see this quarter, you will see that we are at around 14% volume growth. And if this 800 tons would have come, this would have gone up to approximately 20-21%. And we could have made up a little bit in this quarter. But, there was back-to-back issues that happened in both the quarters. Otherwise, things would have been better as far as numbers are concerned. But having said so, even in spite of, the Red Sea issue, we did manage a 14% volume growth. And we expect all of that to get translated in quarter 4. And hopefully, as far as the top line guidance is concerned, there won't be any change in terms of our growth trajectory. Probably, yes, this 5% of profit loss that we probably got impacted because of the breakdown, that could lead to certain kind of a profit re-guidance. But that will again depend on on the claims, etc. So broadly, the guidance remains the same. Yes, this impact we will be able to know only by the end of the quarter.
Okay. And connected question is that, let's say this Red Sea problem persists and, we have to use a different route. Who bears the expenses?
So, Kashyap, as far as we generally have two kinds of contracts. So for the FOB contract, of course, the buyer bears the expense. There are certain contracts, approximately, 30% of our contracts are CIF contracts. So of course, that expenses will be borne by us. And that in fact could lead to a little bit of compression in the EBITDA margins.
Okay. And some bookkeeping question. Can you give the gross debt as well as the inventory, receivable and payable numbers for the quarter? Can you share that?
I'll just ask our CFO to give you the numbers.
Sure.
So the debt as of now it is around 1,300 crores.
Okay.
Okay, and the receivables are around 60 days and the payables are 50 days.
I can't hear you clearly.
No, the receivables are around 60 days and payables are at 15 days.
Okay. And including this additional inventory of about, let's say, 40-50 crores, what would be the inventory number?
Inventory it was almost around finished goods, if we take it around 130 crores.
Sorry, I didn't.
130 crores. 130 crores.
Additional versus previous quarter.
Yeah. Total as on 31st December, which would have been less by selling it off that 800 tons, which is maybe around 35 crores less. We might have ended around 102 crores.
102 days, right? Not
102 crores by selling it off another 800 tons, which we are supposed to dispatch.
Sorry, I'm getting a bit confused. So, can you give me exact inventory number on balance sheet as on 31st of December?
It is on finished goods, it was 135 crores.
Okay. And other inventory, raw material as well as finished goods?
Raw material, we have almost around group level around 400 crores.
Okay. Okay. Got it. Yeah. Sorry, that's it from my side. Thank you.
Okay.
Thank you very much. The next question is from the line of Amol Rao from Kitara Capital. Please go ahead.
Good morning, gentlemen. So just, couple of questions on the outward freight side. Now, as the previous participant asked, that we might incur some additional expenses for the freight for our CIF contracts. Does the export time also elongated? So should that reflect a little bit in our receivables also? Because they're going to take a longer route, right? So
yeah, they. So it's more 4 to 5 days. It's not really, really needle changing. Yes, but there will be a little bit of a delay. So 5 days of more delay if they go to Cape of Good Hope. That could impact a little bit. But these are little impacts. We are not seeing at a larger level. Things will change drastically for us.
Okay. And so another question which is had a larger scope. There is no deferral of demand, right? The demand remains intact. It's just meeting that demand that is taking a little longer from our side, right?
Yeah, there isn't any issue with the demand, and the demand remains intact, and it looks like there is in fact a more pent-up demand which is getting reflected in the coffee prices as well. So we are not seeing any sort of issue with the demand side. That's been more of our supply constraints that we have internally. Otherwise, demand is intact.
So if I may just squeeze in one more question. So the last time we spoke in December, you alluded to coffee prices being at 3 decadal highs. What's the sense you're getting on the Vietnam crop? Are the prices still elevated in anticipation of the poor rains, or anything you're seeing on that? Anything that you could help us with, on that?
Yeah. So in fact, since the time we last spoke, the coffee prices have gone up quite a bit. It is almost at an all-time high and unexpectedly high because nobody expected these kind of prices. So yes, there are two things. One is, as we spoke earlier, the demand remains robust. So there is a huge amount of coffee which remains intact. But yes, there are issues in terms of supplies because of probably poor output of the crop, or at least there is a perception that there are poor output and there are fund guys playing into this. The coffee farmers are wanting to hold stock because everybody is in a more of a upward trajectory mode. So all that is leading to high coffee prices. Future outlook, all our outlook has gone wrong for the last 2 years. So very difficult to predict which way it could turn around. Probably takes a trigger to turn things around. But as of now, in the short term, we don't see any sort of price indication that which side it will go. Looks like it will remain at these levels for some time.
And in the middle of all this chaos, our business model remains intact. That is, we book the coffee back to back when we get our order.
Yeah, our business model. Yeah, there is no change in our business model. We kind of book back to back, and we don't kind of buy coffee unless until we have orders.
Got it. And sir, on the expansion side, are we on track with our expansion in India, which is basically going to come in probably in October, November of this year?
No. India expansion wasn't October, November. It was March. So that is on track. The Vietnam expansion was July, September quarter. That is also on track. So we are on track for both the expansions.
All right, sir. Thank you so much and wish you all the best.
Thank you.
Thank you very much. The next question is from the line of Shirish Pardesi from Centrum Broking. Please go ahead.
Hi, sir. Good afternoon. Thanks for the opportunity. I have a few questions. You mentioned that 14% volume growth. Can you break that growth for India and Vietnam? And the second question is that if you could talk something about India branded business and the institutional part of the business and modern trade. So maybe segmental, what kind of growth you have seen in the
Right. So, first of all, answering your first question, India volume growths were in fact we declined, because if you remember last year we were doing third-party buying and all that, and also add to it the deferment that happened at the end of the month. So there was almost a 10% or 10 odd % decline. And Vietnam capacity is almost at a almost at a 40-50% upside because of the new capacity and the aggressive selling that we were doing. So this is the breakup of these two segments. As far as India domestic business is concerned, India domestic business for the 9 months, we almost did done approximately 230 to 235 crores, out of which the branded business itself is approximately 145 crores. If you remember, for the last year, we had done full year of 150 crores of branded business. We were able to touch in 9 months. Projection-wise, this year we are looking to touch the 200 crore mark for the brand alone, and 320 crores or so for the full domestic business. As far as channel growth, I think most of the channels are growing at the same momentum. The brand currently is on a 40-50% kind of a growth momentum after a bit of correction in Q1, Q2. And we are seeing this kind of momentum happening from all the channels, both all GT, MT, as well as e-commerce. So yeah, it's been an all-round growth for us.
And I think last time you mentioned that our touch points is somewhere around 1.2 lakh and 80% is residing in South. So any update as of December, how it is panning out?
No, so every quarter we kind of add around 2,000-3,000 outlets that we are continuing to do, and we are now kind of last time we had given an update that we are now aggressively trying to expand in other parts of the geography beyond South. So as of now, today in almost all 10 lakh plus population town, we have our distributors set up. So that expansion we are taking, and we are building on some of the other, other brands. So in South we sell Continental Extra. We are building Special in other parts of the country. So all that is happening, and it's been an all-round kind of a growth happening. So in South we are trying to penetrate deeper. So we are now probably touching almost all towns above 50,000. So that's been our strategy: go deeper in South and kind of expand to key geographies in North and key towns, because in other parts of India, coffee is a very archaic phenomena. So that expansion is an ongoing process, and we are taking it along.
Okay. My second last question on the UK acquisition logout. Any update at this time, which is you can quantify how it is panning out?
So, in terms of numbers, we are probably, we would do in fact, there was a period of changeover, and which happens in any acquisition. So from July onwards, we started taking things onto us, and then we started reworking on the product, packaging, and all the promotions with our UK partners. And, we took around 4-5 months to kind of, stitch everything together. We are now good to relaunch. March end is when we are looking to relaunch with our new packaging, new product, and new strategy at all stores in UK. So this year's numbers will not be much. It will be approximately, 15 crores or so. But then after March relaunch, we'll be able to update that how the relaunch has been, appreciated in the market and going forward. But yeah, a lot of work happened during this interim time in terms of relaunching the whole proposition in the market.
My last question on margin front, we have been able to hold on between 40-41% gross margin, while the EBITDA has been a little on the lower side. So in the medium term, what are the pain points where do you think, you touched upon the coffee is still looking inflationary, but is there any margin room for growth for us, and how we should look at the next year margin?
So, like last time we had pointed out, there is no apparent or very, reasonable kind of a deviation that we are looking at margins, because there are 2-3 factors or 4 factors that will play up. One is definitely is the product mix. So if you would have seen our product mix for the current expansion and the expansion which is coming in India will be on the spray dried side. And spray dried, you earn a little less margin than the freeze dried side. Then what will happen is next year, September onwards, October onwards, the freeze dried capacity will come. So that will improve the margin. On the other side, we are also trying to focus a lot more on small packs, which helps us give better margins. So we are looking at specialty coffee, which will help us. So, there are a lot of factors which are going to play around. There are some factors which will pull up the margins, some factors which will bring down the margins. So on an overall consolidated levels, we don't see much of a change in the margin that is going to happen in near future. But yes, going forward, once things get stabilized, once your mixes get stabilized, once some of our initiatives regarding small packs, specialty coffee, they all start coming into play, then we probably will start seeing improvement in margins as well.
Thank you. Thank you, sir. Wonderful, and all the best to you.
Thank you.
Thank you very much. Next question is from the line of Akshay Chheda from Canara Robeco Mutual Fund. Please go ahead.
Yeah, sir. So thank you for the opportunity. So 2 questions. So first question is, sir, you said that 14% volume growth, but EBITDA growth is only 10%. So what explains the 4% gap? Because ideally we keep guiding that the EBITDA and the volume growth should go in hand. So, sir.
So, Akshay, actually, it's EBITDA growth is, if I'm not wrong, around 11%, yeah, and it's 14%. So there has been a 3% drop. As I mentioned a while ago, the 3% drop is because in our volume mix we did aggressive selling at Vietnam because not every product fetches you the same kind of margins. So what we did was, because we wanted to fill capacities and make up for the losses that we had in Q2. We did some low margins contract as well in Vietnam, which led to a little bit of a squeeze in margin, which you can see in terms of 2 to 3%. But in overall scheme of things, if you see YTD, there isn't much of a difference. We are actually, there is 12 to 13% growth in volumes and 15% growth in EBITDA. So we are probably, at a YTD level, we are intact. And as I always have said that, at a quarterly level, these big changes and all that could come into play, and therefore you may see some variations. But on an annual basis, our guidance remains intact. Volume growth and EBITDA growth will be always in line.
Okay. So second question is, sir, if we see the second and the third quarter, so at least the EBITDA growth was around 13 and 10%.
Right.
So, but on the annual guidance, does that 18-20% volume growth still hold true, or so we'll have to curtail that to some extent, because at least the second and third quarter we are lagging a little bit.
Yeah. We are lagging, but actually a couple of things. One is that volume growth, we are pretty confident that we'll be able to get to that 18-20%. In terms of EBITDA, because of that, that loss in Q2 at Vietnam, and subsequently when we are trying to cover up, obviously, as you're seeing in Q3, there is a little stress on margins because we want to aggressively cover the top line. So there could be certain, drop because we may not get the insurance claim this year. It may happen later. But broadly, if we were to get that insurance claim, that guidance of 18-20% remains intact, both for volume as well as for EBITDA.
Okay, sir. This was very helpful, sir. Thank you.
Thank you very much. The next question is from the line of Abhilasha Satale from Quantum AMC. Please go ahead.
Yeah, thank you for taking my question. So I have one question in terms of working capital. So can you just throw some light what is the impact of Red Sea issue on our overall working capital in the near term? You can just give, approx the numbers in terms of how much you're seeing the impact. And secondly, as our Vietnam capacity stabilizes, what kind of working capital outlook we are seeing for that? Because, in the last 7 or 2 years, we've seen some increase in working capital, maybe because of the different issues. But as we stabilize all our capacities, what are the working capital days, what we will be comfortable with? This is my first question. Thanks.
Yeah. If you look at it, the kind of revenue growth and the volume of the production that is happening, we have aligned with the enhancement of the working capital facility in India by 200 crores. And whereby now earlier the 400 crores working capital loan, it is likely to increase to 600 crores in India. And regarding the non-coffee Vietnam, wherein the new capacity has come into operation, earlier we have almost around 15 million USD working capital exposure. Now it is going up to almost around 45 million, which we have necessary arrangements have been taken place. As a whole, if you look at it, the working capital is likely to be from earlier 600 crores, it has gone up to 1,000 crores.
Okay. So, are we seeing, are we taking any measure to bring it down as this facility stabilizes? So, over the next 2 years or so, maybe, in percentage of revenue and all, where would we like to, or what is our target to stabilize our working capital at?
So now we are at the peak level. It is likely to go up another 200 crores maximum by next year. But post that, it is the free cash flows are going to be available. Then we keep reducing it.
Okay, thank you. And my second question is, what is our burn on branded segment in 9 months FY24? And can you give some roadmap towards profitability for the segment?
Can you just repeat? Your voice is a little, it's not very clear.
Okay, is it better now?
A little better now. Yeah.
Oh, okay. So my second question is how much is burn on branded segment in 9 months FY24? And can you give some roadmap towards profitability for the branded segment?
Okay. So first and foremost, there is no burn there because last year itself we had indicated that we have broken even. And probably from this year we will be at 5-6% EBITDA levels, which will keep increasing as we go along. But yeah, the fundamental principle here will be that we will try and invest as much as possible back into the brand because we really don't want to slow down the momentum at this stage when the brand has got that momentum and is getting into that threshold levels of being a fairly largest brand. This year we are looking to end the year at just the brand segment at 200 crores. So that's a very, very big milestone because there are not many brands who kind of have achieved this kind of a milestone in this short period. So we really want to keep up the momentum, keep investing back into the brand. But yes, 5-6% of EBITDA is definitely there right now, and we will see how we can improve it. But with this thing that we really want to right now be invested in brand building.
Sure. I appreciate, but I think at PAT level, we would still be burning if I'm not wrong.
No, so after so there isn't much of this thing PBT. There is no this thing. The brand demerger has happened, so there aren't any in loans to be serviced or it's not asset this thing. So there isn't any depreciation or anything. So there is not much of difference between an EBITDA levels and at PBT levels. So except for the vending machines that we buy, which probably have a little bit of depreciation and interest, but those are very less in number. So there won't be much of, say, if the EBITDA levels would be at around, let's say 5-6%, the PBT could be at around 2-3%. And the PAT will not be getting impacted so much. So therefore there isn't any burn even at the PAT level also.
Okay, sure. Thank you. Thanks.
Thank you very much. The next question is from the line of Ankit Kanodia from SmartSync Services. Please go ahead.
Thank you for taking my question, and apologies if these questions have already been answered. You may skip it. My first question is related to the tax outgo. So